Good evening. Once again, we welcome you all to this webinar session of CNB. Before we start with the session, we would like to extend our sincere gratitude to the members and the participants who have joined with this webinar session and being a participant till date. So, before we start with the session, we'll just have a quick introduction about us, that who we are. So we are a consulting and beyond one of the leading financial advisory and management consultant based in Chennai. So we have 25 plus years of experience, and we have an expertise in our company to serve the client in a better way by reducing the tax and to maximize the sales and profit simultaneously. To achieve this, so we have created a 4 business verticals in our company, namely audit and assurance. In that, we do audit and we assure with the financials of our clients with the reliability and compliance of all tax losses to give so as to give the confidence to them. And next one is tax advisory. In that, we give advice to our clients and business entrepreneur to reduce the tax by showing as maximum as profit. And the third one is management consulting. In that, we do all business process re-engineering. So we advise our business entrepreneur, because many business entrepreneur knows how to start a business, but they will not start, but they will have stuck in one such a places. So we guide them accordingly. We start a business process, and normally we advise them how to procure the products and what kind of software that they have to use and how to implement the business and all. So all sort of things we do in management consulting. And the last one is corporate finance. In that, the main we focus on the bank loans for clients. If suppose a client or business entrepreneur requires bank loans, like for example cash credit or OD account, etc., like housing loan and all. So we focus on the bank loan perspective. So we guide them accordingly how the projections and provisional balance has to be prepared as per banker wise. So this was normally we do in corporate finance. So these are the 4 business verticals that we created as of now to achieve our ambition, which is to maximize the shareholders' wealth and the profit. So before we start with the sessions, we would like to thank our founder, C. Umesh Gulecha sir, and Ratandeep madam, Arun Chalamuthu for giving a guidance with regard to this sessions, and myself is Kaviraj, and Bharathi analyst, and Harinee. So we are going to take the session with for filing form 9 and 9C. So now let us go into the presentations on how to file form 9 and 9C for financial year 2024-25. So most of the participants would know about what is 9 and 9C because they have been filing this for many years, but still we're going to just brush up what is 9, what is 9C, and what all the changes has been implemented for the financial year 2024 and 25 recently. The agenda for this session is just what I said, is that introduction to the form 9 and 9C, latest changes in form 9 and 9C, and how to report the changes and how to avoid the notices by updating the changes. So we'll go one by one. Let's see about the applicability of 9 and 9C. We all know that we have been filing GSTR 1 and 3B and annual returns also. So we comprise everything and we have to file in one return called 9 and 9C. To whom it is 9 and 9C is applied? For all taxpayers or for no? There are some restrictions. This will be applied for all regular taxpayers who the turnover crosses 2 crore but does not crosses 5 crore. For them, 9 is applied, whereas 9C is not applied. If the turnover crosses more than 5 crore, form 9 is also applied and form 9C is also applied for registered taxpayer alone. For composite dealers, they have to file GSTR 9A but not 9 and 9C, and for e-commerce businesses 9B. So these are all the basic forms which is required to be filed by the taxpayers. Now, whether this form 9C is applied to all the registered taxpayers? No, there is some exclusions is there. So who are all come under this? First one is input service distributor. That means they distribute the input to have the claim. The distributor will not file form 9 and 9C. Whereas if the taxpayer deducted TDS under section 51, for them form 9 and 9C will not be applied. Now casual taxpayers also. non-resident tax persons. Now, central and state government comptroller for audit in general for them. For these taxpayers, Form 9 and 9C will not be applied. Exclusively, they get an exemption from filing these forms. Now, let's see about the basic consequences if suppose the taxpayer does not file GST 9. A notification has been given in number 7 and 2023 by Central Tax, dated 31st March 2023, that if suppose the assessee, the taxpayers, has not filed 9C up to 5 crore per day, 25 rupees for CGST and SGST, or 0.02% of the turnover on the sales. And if the turnover more than 1.5 to 20 crores, then the late fees will be applied for 50 CGST and 50 SGST and 0.02% of the turnover. If suppose the turnover crosses more than 20 crore and 100 rupees for CGST per day and SGST 100, here 0.25% of the turnover will apply. So these are the penalties that the taxpayer has to face if suppose they are come into picture of 9 and 9C filing and if they didn't file or they filed under a wrong procedures. So these are all the penalties they have to file. They have to bear. So before that, please ensure before filing what all the mandatory document they have to keep on your desk, what all the checklist has to be done before filing, and then file in a proper manner, correct manner accordingly. Now, these are all the basic things that we have seen about Form 9 and 9C. Now, we are going to see what all the major changes has been given by the government with regard to this filing of 9C and 9. First one is ITC of preceding years claimed to be reported under table 6A1. There is a column given specifically by this year from financial 24-25 filing, that is called 6A1. It shows the preceding year, what is the ITC, and the current year. The segregation has to be given. Earlier, the segregation was not there. Lump sum ITC has been given. So now it has been eliminated now. So this is a new updation. And table 6M with residual credit. What means residual credit? That we'll see in upcoming slides. So what are the credit that can be claimed? Earlier, we have to claim everything. Now there is a restriction has been given, that is new assessee, new taxpayers, new registration has been done. What all the credit that has been accumulated, that has to be filed in table 6M. So in deep, we'll see that. Then mandatory disclosures under part 5. Part 5 will see about the disclosures, what kind of disclosures the government is required to be filed. Now, reversion angle. In that reversion angle, ITC reversed earlier that can be reclaimed under table 6H. There is a column called 6H. ITC earlier been reversed. You know that what is reversal of ITC? Once it is reversed, now the taxpayer wishes to claim this ITC now, they can claim provided there is proper classification has to be given in the reversal of ITC in table 7. That is a mandatory one. And the next clarification, disclosures on under 6B. So what kind of disclosures? All disclosures like part 5, what I said earlier, under 6B, all disclosures will be taken separately in the slides. What all thing I mandated that assessee has to follow. Now table 8H. When you talk about table 8H, earlier there were two things were there. Table 6B and table 6H. Both the things has to be included in table 8H. So now the 6H has been eliminated and it has been given to the reversal part. And now the table 8H should be equal to the 6B. Now disclosures with regard to the ITC on imports. Imports, you know that. So how to claim that imports? What are the procedures has to be given? That's a new implementation. So these are all the major part of changes has been done in the form 9. So how to file and how to report, we'll go one by one. This is with regard to the GSTR 9. Now changes. Let's see about the changes in form GSTR 9C. There is only two things which major changes. One is reporting aspect and another one is payment aspect, because liability always falls under from 9C. Even though if you fill 9, then liability will come out in 9C. So how to report? There is separate reporting for supplies and tax section 9.5. It means for e-commerce businesses, the input they have to give separately. Now, with regard to the payment, earlier, if any liability arises in 9C, they have to pay to DRC 03 when the cash ledgers. But now it has been extended to credit also, because even though if you have a credit in ITC, you can claim either in cash or in ITC. These are the new things has been given changes. in 9 and 9C. So now let's go in deep about giving all the things, how 9 and 9C works. Now let's have a quick poll that how far we have understood about the basic thing about 9 and 9C. You all understood about the basic criteria to fill form 9 and 9C, who has to fill, who should not, whether it has been compulsory for all the registered taxpayer, exclusions, everything is there. Let's have a quick poll. Can a taxpayer with turnover 1.75 crores file Form 9 under CGST Act? So please recap yourself that what could be the answer and whether they have to file mandatorily. The turnover is 1.75 crores. So we have discussed through some slides. So the answer is no, because it's not mandatory for all. Till 2 crores, the assessee, if wish to submit Form 9, they can do so. If the turnover crosses 2 crore, compulsory they have to do. So most of you have given the right answer. Hope that you've understood about the basic concept about 9 and 9C and all. So now we are going into deep about the changes and the implementation, how to report in 9 and 9C, and how to avoid notices by reporting in a correct way without paying a penalty, how to come out of this things by complying all the statutory laws. Now we'll go one by one in deep, and our analyst Bharathi is going to take about in depth about 9 and 9C, how it's going to take place. So
thank you, sir. Good afternoon, everyone. Let us dive into one of the most important GST updates of the year. Whether you are a tax professional, compliance manager, business owner, or finance enthusiast, the changes in GSTR 9 and 9C are going to shape how we close this financial year. In the next few minutes, we are going to break down what's new, what's simplified, and what's mandatory, and most importantly, what you must do to stay compliant and avoid last minute chaos. So let's get started. Before moving on to the topic, let us discuss why there is a need for GSTR 9 and 9C. The need for GSTR 9 and 9C is to have an opportunity to correct the mistakes and changes with regards to turnover mismatch, input excess claimed, or input which is short claimed, or input which is short reversed. To put into small words, it will be like a second chance. And why the changes have been made in forms. There is a need for granular ITC reporting. This is to provide highly detailed invoice level information regarding the ITC claim, reversed and reclaimed. The key aspects of this granular ITC reporting is to have an invoice level tracking, supplier wise in the books as well as on GSTR 3B. So this will enable us to have a reconciliation to be done in accurate manner. On doing the reconciliation, we will report those things in form GSTR 9 and GSTR 3B. So it must be done in such a way that in order to avoid the discrepancies. On doing so, we will have the ITC statements and electronic credit ledgers as well as electronic cash ledgers and electronic credit reversal and reclaim statement in a compliant way, and it will enable us to reflect the reporting in more transparent way. So what is the impact on the business? It helps to file a meticulous record keeping on purchase registers and outward liabilities as well. This helps to have an increased compliance in filing the returns. And to conclude with the granular ITC reporting, it helps to make proactive measures to avoid the notices. So let's move on to the changes in GSTR 9. The first change is about segregation of the previous year credit in table 6. Table 6A in GSTR 9 auto-populates the total ITC availed from GSTR 3B, which may include the previous year credits too. So, to separately disclose such past year ITCs, a new table 6A1 has been inserted. So it will capture the ITC belonging to the earlier years that was claimed earlier, reversed, and then reclaimed in the current financial year. So for example, if rupees 100 has been claimed during the earlier year, there will be reported in table 6A in the previous years. But now it will be reported separately under 6A1 in the current financial year. So this ITC should not include the Rule 37 and 37A. What is Rule 37? Rule 37 means when the supplier makes the supply to the recipient, the recipient is not making payment within 180 days, then it is Rule 37. And in such cases, the ITC will be reversed. In Rule 37A, it means the non-payment of GST by the supplier. So in such cases, when we make the inward supplies from the suppliers, such ITC should be reversed when the supplier is not filing GSTR 3B. This will help to ensure the accurate reporting and helps to keep the table 6J at zero difference. Then let us move on to next change, where it tells about the clarity on the disclosure of ITC availed, reversed and reclaimed in Table 6B. Table 6B from financial year 24-25 states only the first time availed ITC. So from now onwards, ITC availed should be reported in Table 6B, whereas ITC which is reversed should be reported in Table 7. And ITC which is reclaimed should be reported in Table 6H. Now let's move on to another change, that is disclosure of ITC reclaimed in Table 6H. Table 6H should report ITC reclaimed during the year only if the earlier reversal was due to the Rule 37 and 37A as we discussed earlier. Even if the original claim and reversal were in previous year, we should take only the reversals which is made in Rule 37 and 37A. If the reclaim relates to any other reason, it must be reported in Table 6A1 instead of Table 6H. Then we'll move on to next change, where it is about the disclosure of residuary credits in Table 6M. Table 6M will now be used only for reporting ITC taken through forms ITC 01, ITC 02 and ITC 02A. So it will be no longer include the previous year credits or other residual credits. Any earlier year ITC claimed within the allowed time limit must not be reported in Table 6A1. So all the ITC 01 will be filed for business transition. Like we have business transition in 4 scenarios, where an unregistered person becomes a registered person once his aggregate threshold limit exceeds. Then we have a voluntary registration, where a taxpayer himself voluntarily makes registration. Then third one is about the regular scheme, when the taxpayer is entering into the regular scheme from moving on to the competition scheme. Then we have the supplier who is making exempt supply, but now those supplies are being taxable. So in these cases, the ITC 01 to be filed in order to avail the ITC. ITC 02. ITC 02 refers to the transfer of unutilized ITC when one registered business entity will be transferred to another business entity when the business is undergoing any change in constitution. This means that when there is a sale, merger, acquisition or amalgamation, there comes into picture ITC 02, where the unutilized ITC will be transferred from one business entity to another business entity. Then comes ITC 02A, where a registered person who has multiple place of business within the same state or union territory and obtains a separate registration for one or more of them will be under this, where it allows transfer of unutilized or matched ITC from the existing entity to the newly registered entity. Then next comes the another change, where changes in table 7 to disclose the reversals of ITC. So this table in earlier years, the table 7 has no separate insertions of A1 and A2, but now A1 and A2 has been inserted in order to disclose the reversals made under Rule 37A and Rule 38. Earlier, there were only one column, which is 7H, in which all the reversals has been made, that is 7H other reversals. So now it is given under 7A1 and 7A2. As we saw in previous slides, what is Rule 37A, we will see what is Rule 38. It is nothing but the reversal made by the banking and financial institutions. Then here comes the other change, where the table 8B would be the amount provided in table 6B. As Kaviraj said in earlier slides, on jotting down what are the changes, we would have come across table 8B is equal to table 6B. Earlier table 8B were used to be table 6B plus 6H for matching with GSTR 2B. But from now, financial year 2024 to 25, only the values in table 6H will be considered. Since 6B is now expected is to include all the first time ITCs, including those later reversed. So this change improves the accuracy and in alignment with the GSTR 2B for reconciliation purposes. Then the next changes is on issue with respect to the disclosure of import credit rectified in table 8. A new table 8H, has been introduced to separately report the IGST credit on imports that is claimed in next financial year. So earlier, such details were mixed with table 8G and table 8H, causing the differences to appear as unclaimed or lapsed ITC, making ambiguity between the taxpayers in their perspectives. But now it has been declared in table 8H1 that the next year IGST credit on imports will be taken to the next financial year in 8H1. So the new table ensures that correct and transparent disclosures of import IGST credit will be claimed later. Then disclosures made mandatory in part 5. From the financial year 24-25, tables 12 and 13 are now made mandatory. So table 12 will report ITC of the year reversed in the next financial year from April to October, while table 13 will report ITC of the year availed in the next financial year, April to October. And additionally, tables 10 and 11 have been clarified that table 10 will include the upward amendment, that is on invoices and debit notes, and table 11 will include the downward amendments, that is on credit notes and reductions made from the April to October of the following financial year and filed up to 30th November. So this will align the existing reporting practice followed by the most of the taxpayers. So let's move on to the changes in GSTR 9C. Now in GSTR 9C, we have only two changes, where amendments made in tables 7, 9 and 11 to disclose the details of supplies made to e-commerce operators, wherein such operator is needed to discharge the tax under 9 subsection 5 of CGST Act. So what is table 7? Table 7 reports on the reconciliation of taxable turnover, where now we should disclose the supplies made through e-commerce operator liable to pay tax under 9(5). And This will get reduced from the gross turnover after the adjustment made, which is brought forward from the table 5. Table 5 talks about the reconciliation of the gross turnover. From that gross turnover, we have to reduce the supplies which is made through the e-commerce operator in order to arrive at the taxable turnover. Table 9 reports on the reconciliation of rate-wise liability, wherein we should just disclose the details of supplies made to e-commerce operator. Now, there is a thin line of difference between the table 7 and table 9. Table 7, supplier will declare the details because he has to disclose his taxable turnover. So, when a supplier is making his reporting his GSTR 9, he should report the reconciliation of taxable turnover with the supplies which is made through e-commerce operator, because in table 5 we have gross total turnover, and from that it will get subtracted in order to arrive at the taxable turnover, because the supply which is made to the e-commerce operator, the e-commerce operator will pay tax and the supplier is not liable to pay tax. That's why it will get reduced from the turnover in order to arrive at the taxable turnover. When the table 9 is to be reported by the e-commerce operator in order to declare the details to show his liability when he is filing the GSTR 9. Table 9 is reported by the e-commerce operator because he is having the liability to pay the tax. That's why table 9, the e-commerce operator will he will report the details there. Then in GSTR 9 also there is suitable changes made in instructions to provide the payment of additional liability through e-credit ledger. Earlier it was under e-cash ledger alone. So now it is on both e-credit as well as e-cash ledger. So that's all for changes, and now let's have a quick brush up on tables in the form 9 and 9C. Form GSTR 9, Part 1 tells about the basic details. Part 2 on the details of outward and inward supplies made during the financial year. That is further divided into table 4 and table 5. Table 4 tells about the details of the outward supplies and inward supplies made during the financial year in which tax is payable. Table 5 reports on the details of outward supplies made during the financial year in which tax is not payable. Then comes part 3 where details of ITC availed during the financial year. It has 3 tables where table 6, table 7 and table 8. Table 6 tells about the total ITC availed with some changes in it as we saw in few minutes back later in the slides. Then table 7 will talk about the total of ITC reversed during the financial year and the net ITC available for utilization. Then table 8 will report on the other related information where we have to have where we will have to report on the ITC lapse in the current financial year. Then table 9 talks about the tax paid in cash and credit and also the tax payable. Then comes the part 5 where transaction of previous financial year declared in returns of the April to September or up to the date of filing annual return, whichever is earlier. This part 5 we have discussed in changes which is to be made mandatory, that is table 10, 11, 12 and 13. So let's move on to table 14. Here table 14 is about the differential tax paid on account of declaration in 10 and 11 above. And table 15 talks about the particulars of demand and refunds, and 16 on the received from supplies which is received from the composition taxpayers. And 17 is about the HSN wise summary of outward supplies made, which is mandatory to be reported. And then table 18 deals with the inward supplies in which HSN is to be reported, but it is not mandatory, it's just optional. Then table 19 is on the late fee which is payable. So that's it for form GSTR 9. Now let's have a glimpse of what is Form GSTR 9C. 9C Part 1 is same as Form 9, and Part 2 reconciliation of turnover declared in audited annual financial statement with turnover declared in annual return GSTR 9. It has two tables where table 5 and table 7 will take into picture, where we have table 5 reconciliation of gross turnover and table 7 reconciliation of the taxable turnover, as we have seen in the changes which is made in GSTR 9 before earlier slides. So let's have a quick look into part 3. Part 3 refers to the reconciliation of taxes paid. It has table 9 and table 11. Table 9 tells about the reconciliation of rate-wise liability and amount payable. And then table 11 deals with the additional amount payable but not paid. Then comes the last part, where part 4 reconciliation of ITC will be made. Under this we have three tables, that is table 12, 14 and 16. Table 12 deals with the reconciliation of net ITC, and table 14 deals with reconciliation of the ITC declared in the GSTR 9 with the ITC availed on the expenses in the audited financial statement. And then table 16 deals with the tax payable on unreconciled differences in ITC. Then the last part is on the auditor's recommendation on additional liability. So that's it for changes and Form 9 and 9C. Now the session will be taken over by Harinee. Over to Harinee.
Thank you, Bharathi, for your insights on changes in Form GSTR 9 and 9C. Now, let us move to the most practical segment. How do we avoid departmental notices while filing GSTR 9 and 9C? This is extremely important because most taxpayers who receive scrutiny notices have lapses either in ITC matching, turnover reporting, or misclassification. These are some of the scrutiny points on notices. First cause is that difference between ITC claimed in our monthly returns and reported in annual returns comparing to GSTR 2B. RCM claimed versus RCM actually paid. RCM should be paid in cash and the same can be claimed as ITC, but we cannot utilize more than what we paid. Turnover declared in GSTR 1, 3B and 9 should be same. Differences in them triggers notices. Since we are reporting the taxable value of our supplies while generating e-way bill, our turnover has a record in it. So, difference in turnover with e-way bill generator shall also be a cause for issue of notice. While filing GSTR 3B, we will reverse the ineligible ITC, while we also reported in our GSTR 9. Differences in disclosing the reversal of ITC in these returns may also doubt our ITC claim, which may result in notice. A new clause A1 has been inserted in Table 6 of GSTR 9, which may be expected to match with Table 8C of GSTR 9. Finally, defaults in reporting HSN summary in GSTR 1 may also result in notices. Practically, these are the areas where many of us faces discrepancies. Let's have a deep discussion on these issues. First, in general, our input tax credit will be reflected in our GSTR 2B after our supplier has filed GSTR 1. The eligible ITC in GSTR 2B will be auto-populated in GSTR 3B, though which we can set off our liability for the month. If there arises any mismatch in the ITC, it may be the result of the following causes. That is, we may have reversed some ITC in GSTR 3B, but we had under reversed in GSTR 9. Or we might have claimed ITC on supply from the supplier who has failed to pay tax in GSTR 3B and whose registration has been cancelled by the department, resulting the claim of ITC without satisfying the rules of eligibility to avail ITC. Or we may have paid excess liability on RCM over which was reflected in GSTR 2B, which may be genuine, like rent, security charges, freight from unregistered persons. But we should not pay RCM less than what is reflected in GSTR 2B. So, as and when we are filing GSTR 3B, we should have a track on details reported with regard to ITC as well as outward supplies reported. There is table 8 in GSTR 9 which reconciles the ITC available as per GSTR 2B with ITC claimed as per the GSTR 3B. If it resulted in difference under table 8D, the difference should not be negative, that is, the ITC claimed under 3B should not be more than the ITC available under 2B. This difference may also trigger notices which ends positive only under two scenarios. The first may be the ITC of previous year which was claimed in current year which results in negative difference. Next, current year ITC which was claimed in the next year which results in positive difference. And the final, the case where we genuinely underclaim which results positive difference. Generally, in this case, department is not considering about the short claim as there is no revenue loss to the department. Next, breakup of what we had filed in GSTR 3B should match with table 6. For example, if we report import of services under table 4 of GSTR 3B, we have to report the same in GSTR 3B under form 6E. We have to follow the classification as classified under GSTR 9 as inputs, capital goods and input services. Next, difference in RCM paid versus what is actually claimed. In general, RCM as per 2B will be auto-populated. If we report excess liability, as we may have received supplies from unregistered persons, for claiming the same, we have to report the respective increase under input table also, that is, under table 4 of 3B. We have seen many cases where persons had genuinely paid the excess RCM reported but failed to claim the same. If we had increased the output but we had not reported the same under input RCM, it results in loss for the business entity. But if we are able to get aware of the same before November of the succeeding year, we could claim this as our ITC and also we could claim other ITCs which were short claimed earlier through GSTR 9. As we work towards filing GSTR annual return, we will surely get to know this. This is one of the advantages of filing annual return. While finalizing GSTR 9, if you come across any RCM liability not paid during the year, the same can be paid only through options. First is, if you don't want to lose this ITC also, then declare the output liability in GSTR 3B up to the specified period and claim the same as ITC in the respective month itself. But if the time has lapsed to claim the ITC within specified time, we should pay the RCM liability along with applicable interest through Form DRC 03. Note that whatsoever be the liability paid under DRC 03, we could not avail ITC on the liability paid. In both the scenarios, we should report the same in our annual returns. Next, if there is any difference in turnover reported between GSTR 1, 3B and 9, this could be a major reason for scrutiny as the department's analytics system quickly detects inconsistencies. Turnover mismatches occur either due to manual editing in 3B or technical duplication of invoices or non-reporting of credit notes. The department has already taken measures to avoid these discrepancies by streamlining Form GSTR 1A, by which we could rectify our mistakes. They had also made the turnover column in GSTR 3B as non-editable one. Next issue is the difference between our turnover reported under GST returns with the consolidated turnover which had reported while generating e-way bill during the financial year. A genuine reason for this difference may be duplication of invoices generated due to technical errors. So, if we receive notice under this case, we should check whether the part B of e-way bill generated has been filled, through which we can justify that the excess bills generated are incomplete and therefore the turnover reported in the same will not be considered as our taxable turnover. Now, with regard to reversal of ITC. It is common that we will reverse the ineligible ITC in our GSTR 3B. In GSTR 3B, we will report the reversals only under two clauses. But in GSTR 9, there are various clauses with rule-wise classification. So, the total ITC reversed in GSTR 3B should match with the rule-wise reported reversals in GSTR 9. So, difference under this case may also tend to receive notices. While discussing reversal of ITC, I also wish to remind you that we should report the gross ITC claim under Table 6 of GSTR 9. That is, the ITC before reversal of ineligible tax should be reported under Table 6. On ignoring this point, we might result in difference which will return us notice. Here, we are going to discuss a new point of scrutiny which will return us notice. The changes made in Form GSTR 9. This is the difference between Table 6A1 of current year with Table 8C of previous year. Table 6A1 talks about the ITC of preceding financial year which was claimed during the current year through GSTR 3B. Well, on the other hand, Table 8C talks about the ITC of current year which was claimed during the succeeding year, that is from April to October of the succeeding year. As we all know, Table 8C was in our Form GSTR 9 even before this financial year, but Table 6A1 is a newly inserted column. So, on linking these two clauses, it is very clear that the department is excited to have a track on our ITC, which does not form part of our current financial year. With this, we can conclude that the ITC reported under Table 6A1 of financial year 24-25 must match with the ITC reported under Table 8C of financial year 23-24. It could be expected that the department may knock our doors through highlighting the difference in above explained scenario. Finally, I like to conclude this topic by delivering an important note that the department may raise scrutiny through HSN summary also. As we all are filing our GSTR 1 with reporting the HSN wise turnover, the department could have a track on our outward supplies as well as our inward supplies. That is, they may track our inward supplies through HSN summary reported by our suppliers. Through this HSN data, they might conclude whether our inward supplies match with our outward supplies made. So, we should have a practice of reporting HSN-wise turnover in GSTR 1 in a proper manner which may avoid notices in future. With this, we conclude our session on GSTR 9 and 9C. To summarize, we reviewed the latest changes in GSTR 9 and 9C. We understood table level reporting of GST annual returns and why segregation is important. Also, we got a note on a common mismatch points and how to avoid GST notices. Don't get surprised when the department knocks your doors for conducting a search. Don't panic when department issues notices, as we are here to help you to resolve this. Be in touch with us in future. We are ready to help you. We request you to provide feedback on the form link posted in the chat box. Let's have a Q&A session. You can raise your queries with regard to this session now. Thank you.